Taxes. Please picture the following. Imagine you have just endured a challenging month at work, working long hours, preparing food at your local McDonald's restaurant. You are in bed when you receive an email from them. It states that you have been paid $2,000, but your bank account shows a balance of only $1,456. You can find more information on the stub. Please note that the following taxes are applicable: federal income tax, state tax, Social Security, Medicare. This is the modern ritual of allocating a portion of one's finances to unseen entities, and there is an expectation of gratitude. The following is the situation. In a civilized society, taxes are an essential component of public expenditure. It is the responsibility of all citizens to contribute to this shared financial burden. The government's responsibilities include the construction of infrastructure, the provision of educational funding, the maintenance of public health and hygiene, and the deployment of military resources in foreign countries. However, it should be noted that there are different types of taxes. Income tax is levied on the money you earn, sales tax on the money you spend, and capital gains tax on the money your investments generate. The government takes a percentage of every dollar. It should be noted that Social Security and Medicare taxes are paid by almost all individuals. Essentially, Social Security tax can be regarded as a method of encouraging individuals to save for retirement. This is a strategy that involves saving money in the present with the promise of receiving it back at a later date, typically upon retirement. Medicare, on the other hand, is a health insurance tax designed to support older people and those with serious health issues. The next step is to file your taxes. This is unfortunate. The government is aware of the amount owed, but the individual is required to estimate it. How cool! If your assessment is correct, there is no cause for concern. However, if there is a discrepancy, the consequences can be severe. With regard to the payment of taxes, some individuals make installment payments on a quarterly basis. Some people opt for an annual payment plan. Furthermore, there are individuals who do not pay at all, and who consequently find themselves featured in documentaries. I acknowledge the frustration surrounding taxes, but it is not without its advantages. Research indicates that countries with higher tax rates generally have a higher quality of life overall. Banks. You enter a banking establishment and present the cashier with your money. The cashier counts the notes, smiles, and informs you that the amount will be added to your account. You exit and consider the potential outcome to be that your item is now stored in a secure facility, protected by a dragon. However, the money has already been spent. The perception of banks as institutions primarily responsible for the secure storage of financial assets is a common one. In reality, they function as intermediaries or facilitators for financial transactions. When you deposited $1,000, the bank retained $900 of it and transferred it to an individual looking to purchase a jet ski. This system is known as fractional reserve banking, which operates on the premise that only a fraction of the money is required to be kept on hand, given that not all customers will request the full amount of their deposits at the same time. That is, unless we are referring to the year 2008. It is important to note that when customers began to withdraw their entire accounts, the system was unable to cope and ultimately collapsed. Financial institutions generate revenue through the lending of your capital at an interest rate that exceeds the rate at which they borrow it from you. That concludes the overview. The supply of money is represented by the lender, while the borrower represents the demand. There are several reasons why banks encourage individuals to deposit their money. It is much more convenient to spend on a card or transfer than to carry around cash at all times. The company is remunerating you for the privilege of retaining your funds on its balance sheet, which is reflected in the interest rate. It is far more prudent to deposit your money in a bank than to keep it in a shoebox in your room. In the US, most banks are insured up to $250,000 per person, meaning that the government has guaranteed the safety of your money up to that amount. Interest. For example, if you borrow $1,000, the total amount to be repaid is $1,280. The reason for this is the interest involved. Interest can be considered the financial cost of retaining ownership of money, even when it is in the hands of another party. When an individual borrows money, interest is effectively the cost of utilizing another party's capital. In the realm of financial transactions, interest represents a compensation for the act of exercising patience and demonstrating prudence. There are two main types. Simple interest can be defined as a flat fee. Thank you for playing. Compound interest is a financial concept whereby the initial investment, in this case a monetary sum, generates additional interest, which is then reinvested. For instance, if you have a credit card with a 20% interest rate, you would need to repay 20% of the amount you spend. In the event of a missed payment, please contact us immediately. Your investment is now generating returns. It is important to note that the value of your $12 meal can rapidly decline to a $50 regret. Conversely, investing at a rate of 7% annual compound interest. This process effectively multiplies your investment value. $100 can be transformed into $200, then $400, and before one realizes it, one has accumulated a significant amount of wealth. It is important to understand that interest plays a crucial role in both the accumulation of wealth and the management of debt. In the context of loans, minor mistakes can escalate into significant financial issues over time. In the field of investments, it is the time bomb that transforms modest gains into substantial wins. What is the most effective approach? If you are paying interest, it is advisable to take action promptly. Should you be earning interest, it would be advisable to leave it untouched, provide it with sufficient nourishment, and allow time to elapse. Interest can be a double-edged sword, either hindering progress or providing a valuable source of free labor. The decision lies with the party responsible for collection. Inflation. It has come to my attention that a bag of crisps purchased by you has been opened and appears to have been consumed in part. Please refer to the payment history to verify that the amount paid is 30% higher than the previous transaction. It is then realized that inflation has occurred. Inflation is defined as the gradual decline in the purchasing power of money over time. This process is gradual and incremental, rather than sudden and dramatic. Your $5 bill retains its value, but its purchasing power has decreased. Consequently, it is worth less than it was previously, and the amount of instant noodles or gas that it can buy has reduced. What are the root causes of this issue? In some cases, individuals possess significant financial resources. In the current economic climate, consumers have disposable income and are keen to spend it on the same items. For example, if 2,000 people express an interest in a $500 TV, but the business only has $1,000 TVs available for purchase, the business will be unable to meet the demand. The company has stated that there is a high demand for this television. That will be $800. Occasionally, supply chain issues can result in increased production costs, necessitating price adjustments to keep pace. Expectations have the potential to lead to inflation. Should consumers perceive an increase in prices, they are likely to make more frequent purchases, thereby accelerating the rate of price rises. This is a self-fulfilling economic prophecy. A certain degree of inflation is to be expected and can even be beneficial. A 2% annual increase is acceptable and predictable. However, if it increases, savings decrease and wages are negatively impacted. In such cases, the government may implement measures to curtail inflation, such as increasing interest rates. When the government raises interest rates, people are paying more interest, or it's more expensive to get a loan, meaning they have less money to spend on things like TVs. This has a contractionary effect on the economy. Recessions. A recession is defined as a period of economic decline that extends over a minimum of 2 quarters, or 6 months. One day, you are in a good place. You have a job, your bills are paid, and you might even be planning a family trip. But then, you experience layoffs and the stock market crashes. During a recession, employment opportunities decrease, companies seek to reduce expenses, and individuals and businesses prioritize saving for essential needs rather than making discretionary purchases. What are the causes of a recession? The issue could be related to a number of different factors. There is a possibility that high interest rates are making borrowing too expensive. There is a possibility that the issue may be related to a global crisis, war, pandemic, or rogue container ship. It is possible that this is simply the economic cycle at work. Boom, peak, bust, reset. Imagine the economy as a social gathering. During the boom phase, all the participants are engaged in dancing and consuming alcohol, but eventually the lights flicker. It is an unwelcome but necessary reminder. A check of the bank account is performed. And then, without warning, the DJs started playing slow, low-quality tracks about corporate downsizing. Recessions are not a permanent economic state. They are periods of adjustment that can be challenging. In response, governments may choose to implement measures such as lowering interest rates, providing stimulus, or encouraging consumers to resume purchasing overpriced coffee. Eventually, spending returns, businesses rebuild, and growth resumes, but not without scars. Credit scores. A credit score is an algorithmic assessment tool that considers various financial and historical data points to determine creditworthiness. This score can influence the approval or rejection of loans, lines of credit, or credit card applications, and it can impact the interest rates offered on various financial products, including mortgages, auto loans, and credit cards. This figure does not reflect wealth. The crux of the issue is trust. Lenders must consider whether the borrower can be trusted to repay the loan. The score ranges from 300 to 850. Should the figure be below 580, then the individual concerned should be considered a potential liability. At over 750, you have attained a level of credibility that is typically associated with adulthood. The majority of people surveyed scored between 640 and 790. Please, could you explain how a credit score is calculated? Please find below details of the client's payment history. Please confirm whether you issue payments in a timely manner. This is a significant development. Credit utilization. What proportion of credit are you currently utilizing in comparison to your potential? Credit age. Please indicate the duration of your account ownership. Credit mix. Cards, loans, mortgages. Variety is beneficial. New credit. The number of recent applications has been excessive. These are the methods used to calculate the figures. In order to increase your score, it is necessary to make the required payments on each of your loans, before the late period is entered. Should you choose to enter the late period, your score will be subject to reduction. Your credit score can be likened to a pet dog in that it is an animal that must be trained and cared for if it is to be kept. If ignored, it can have a detrimental effect on one's life. Maintain this asset, and it may one day contribute to the purchase of a property. This is not about being financially astute. The primary concern is to present a favorable image to lenders. It is possible to have a zero debt and a poor credit score if you do not have a credit history. It is evident that the game is predetermined. However, by acquiring an understanding of its regulations, one can manipulate it in accordance with their preferences. Currency or money. It is interesting to note that currency and money are not actually real. The development of money is an example of human ingenuity with the aim of improving the world. The use of money facilitates trading. This approach facilitates the development of systems and the organization of society. It should be noted that there is no difference in terms of legitimacy between a dollar bill and a Bitcoin. Many people believe that a dollar bill is more legitimate. For the time being, this may be the case, but it is only because people believe it is so. The same can be said for a dollar bill and a stick. The fundamental difference between the purchasing power of a dollar bill and that of a stick is the societal agreement that a dollar bill is worth more than a stick. What is the function of money? The government is responsible for printing it. The central banks regulate it, and everyday people trade it in exchange for goods and/or services. The necessity for banking regulation is driven by the potential consequences of excessive government printing, which can lead to inflation and the transformation of individual financial assets into monopoly money. Should banks succeed in creating a situation in which there is insufficient money, it is likely that people will be unable to make ends meet. Currency, or money as it is more commonly known, is a social construct built on a shared belief and trust. Investing. Therefore, you are now familiar with the concept of inflation. In order to combat inflation and ensure the value of your money is maintained, it is advisable to consider investing. Investing is the process of leveraging capital to generate returns. Rather than exchanging your time for financial compensation, you are able to exchange money for additional financial resources. The issue is that there is a risk involved. Which products and services are available? Stocks refer to the small ownership interests in companies. Should the company experience growth, the value of your share will increase accordingly. Bonds essentially involve the lending of money to a government or company in return for interest. This is a fund that comprises collections of stocks and bonds, thus eliminating the need to engage in financial games on an individual basis. Real estate refers to property that is intended to be occupied by another party indefinitely. It should be noted that there are other factors to consider, although these are generally regarded as the primary ones. Investing is not a matter of chance. The key to success in this field is to be early, diversified, and patient. It is important to note that the majority of wealthy individuals did not achieve their status through lottery wins. They simply allowed compound growth 30 years to run its course. Investing, as with any financial decision, carries inherent risks. Markets are subject to fluctuations, with periods of growth and decline. However, the primary concern should not be the potential loss of financial resources. It is never advisable to invest without taking the necessary precautions to guard against inflation, which can have a detrimental effect on your future financial well-being. Value. This one is more complex, but all parties should be able to understand it. To illustrate this point, imagine you pick up a rock. It is merely a rock. Please imagine that the rock is shiny and yellow, That's gold. Its rarity, exceeding that of a typical rock, results in a higher value being placed on it. It is a misconception that gold is worth more than the average rock. From a business perspective, the value placed on this product by consumers is simply higher than that placed on similar products. Comprehension of this concept is the key to achieving financial prosperity. The principle is simple. The more value you provide, the greater your financial reward. Steve Jobs is the founder of the iPhone, the device you are currently using to access this information. He has created something of significant value. Consequently, he received a considerable sum of money from a significant number of people for that particular item. This is analogous to the high salaries of doctors and lawyers. The value they provide is significant, and people are willing to pay a considerable amount of money for their service. The concept of value is the foundation upon which luxury brands such as Gucci and Louis Vuitton are able to sell the same handbag at a significantly higher price than their competitors, despite offering comparable quality and design. People perceive it as more valuable. This is indeed the case. If you can identify opportunities to create value, even if it is not tangible, you can generate significant financial returns. Time. Time is the most valuable asset in the world. The most advantageous aspect of this process is that the majority of participants begin with a substantial amount. It is likely that you have a significant amount remaining. However, it is important to note that no one possesses an unlimited supply. In the majority of cases, people are engaged in roles where the exchange of time for financial compensation is the primary dynamic. 1 hour, 1 paycheck. It is a simple matter of mathematics. Those at the top of the earnings scale have discovered ways to utilize their time that generate millions. The difference is not due to magic. The key factors to consider are the skills, leverage, and efficiency with which you have managed your working hours. However, the field of investment requires a significant amount of dedication. There is no more effective way to build wealth. It is not a matter of luck, income, or time. Given that wealth is not accumulated over the course of a few days, but rather over the span of several decades, it is essential to adopt a long-term perspective. Securities that are not actively traded can generate returns in a variety of ways, including capital growth and compound interest. The process will commence at a gradual pace, then accelerate. This is why people with regular incomes can accumulate significant retirement savings. It is important to note that the system was not circumvented, it was simply utilized. If an investment of a small amount of money is made at regular intervals over a long period of time, it will eventually become a significant amount.